bank can print money out of thin air, not with a loud machine or a secret basement full of printers, but quietly and legally every single time someone takes out a loan. And if that sounds dramatic, it should. Because this single mechanism explains how your savings account works, why debt keeps growing faster than wages, and how the entire banking system manages to look incredibly powerful and strangely fragile at the same time. Hey, Alan here, and welcome to The Breakdown, where we take confusing topics and break them down step by step so they're easier to understand and actually useful. If there's ever a topic you want us to cover or something you want to explain more clearly, leave it in the comments because we build these videos around what you're curious about. And with that being said, let's get back to the video. When you deposit $1,000 into your bank account, most people imagine that money sitting safely in a vault with their name on it, waiting patiently to be withdrawn later. But that is not what happens, because under a system called fractional reserve banking, the bank is only required to keep a small fraction of your deposit, often around 10%, which means it keeps $100 and immediately lends the other $900 to someone else who needs to pay rent, buy a car, or start a business. That $900 does not disappear, it gets spent, and whoever receives it deposits it right back into the banking system as a brand new deposit, which means the same original money now exists in multiple places at once, not physically but digitally, as balances backed by promises. Now the loop begins. The second bank sees that $900 deposit keeps 10% or $90 and lends out $810, which again gets spent and deposited. Then $71 is kept and $639 is lent, and this process repeats again and again, shrinking each time but stacking on top of the original deposit until your initial $1,000 is quietly supporting close to $10,000 in total loans spread across the economy. Nothing was printed, no vault filled up, and no extra bills appeared in an ATM, because every step of this process creates money by creating a loan, which is why in modern economies the vast majority of money does not come from governments printing cash, it comes from commercial banks expanding credit. This is where the business model really shows itself. Banks do not pay you much for your money, maybe 0.5% or less in a standard savings account, but they turn around and lend that same money out at much higher rates, 15, 17, even 20% on credit cards and personal loans, and much more over time on long-term debt like mortgages and student loans. Think about that relationship for a moment. You give the bank your money for almost nothing. The bank multiplies it through lending, and then charges everyone else a premium to use it, all while you receive a statement congratulating you for saving responsibly, which is not a flaw or a coincidence. It is the system working exactly as designed. This is why banks love debt, especially during good economic times. As long as people are paying mortgages, making car payments, and swiping credit cards instead of asking for cash, the system hums smoothly, interest payments arrive like clockwork, and balance sheets look strong, because to a bank debt is not just money owed, it is predictable income. But here's the part that rarely gets explained clearly. Banks do not actually have everyone's money at the same time. They cannot, because most of it exists as long-term loans like 30-year mortgages and multi-year business debt, which means that banks are liquid on paper but illiquid in reality, and that gap between digital balances and physical cash is where all the risk lies. This is why the concept of a bank run even exists. If too many people show up at once asking for their deposits, even a bank with good loans can fail, not because it is bankrupt, but because it cannot turn long-term loans into immediate cash fast enough, which makes modern banking a confidence-based system far more than a cash-based one. History keeps proving this point. Bank runs are not ancient myths from the Great Depression. They happen whenever confidence cracks, because money created through lending only works as long as people believe it will still be there tomorrow, and when that belief breaks, the system can move from stable to fragile very quickly. This is also why governments step in with deposit insurance, emergency lending facilities, and bailouts during crises, not because banks are innocent victims, but because letting the system unwind all at once would freeze credit, shut down businesses, spike unemployment, and spill into the real economy almost immediately. Zooming out even further, you can see how lending-driven money creation shapes entire economic cycles. When credit expands easily, asset prices rise, housing becomes more expensive, stocks inflate, and everyone feels wealthier, until lending tightens, defaults rise, and the same debt that fueled growth becomes the anchor pulling the system down. This is also why inflation feels persistent. When money is created primarily through debt, the system quietly requires continuous borrowing to function smoothly, which means purchasing power slowly leaks away from people who only save in cash. Now here's the hopeful part, because understanding this system does not mean you're trapped by it. It means you can stop playing defense and start thinking strategically about where you store your value. Instead of keeping all of your wealth in a bank account that loses purchasing power over time, people look to assets that are harder to create and harder to manipulate, like productive businesses, broad market investments, real estate, gold, and increasingly Bitcoin, which is designed specifically to exist outside of debt-based money creation. Bitcoin, for example, cannot be printed by a bank, cannot be multiplied through lending in the same way, and follows a fixed supply schedule, which is why many people view it not as a replacement for banks, but as a long-term hedge against a system that constantly expands. Gold has played a similar role for thousands of years, not because it produces income, but because it resists dilution. And stocks represent ownership in companies that can grow faster than inflation over time, which means the goal is not to avoid the system entirely, but to avoid being fully dependent on it. The real takeaway is not fear, it is awareness. Once you understand how banks print money, you can make better decisions about saving, investing, and protecting your future, instead of wondering why doing everything right still feels like falling behind. So let's answer the question clearly. Banks print money by creating loans, not by printing cash. Every time a bank issues a loan, it creates new money digitally, multiplies deposits through repeated lending, profits from the difference between what it pays savers and what it charges borrowers, and relies on confidence to keep the structure standing. That is how your $1,000 becomes $10,000. That is why you earn pennies while loans cost double-digit interest, and that is why modern money is less about paper and more about promises. Once you understand that, you are no longer just inside the system. You are finally able to navigate it, and that's the breakdown. If you learned something new, leave a like and subscribe, but more importantly, drop a comment with what we should break down next since these videos are driven by your requests. And until next time, stay curious and keep learning.